So let's talk about South Korea. It's a place that's pretty much synonymous with cutting edge tech, right? I mean, they were way ahead of the curve on mobile finance. But right now, they're at this massive crossroads, a real dilemma that's going to shape the future of digital money for the whole country. So, what's this all about? Let's dive in and unpack it.
And really, it all boils down to this one single, super high stakes question. See, as the country gets ready to finally legalize digital assets, there's this huge fight brewing behind the scenes. And it's all about who gets to issue stablecoins. You know, the potential backbone of the entire future financial internet. And trust me, the answer here is going to have massive ripple effects, not just inside Korea, but for the whole global crypto scene.
Okay, so what's setting the stage for this big showdown? Well, it's this brand new piece of legislation called the Digital Asset Basic Act. You gotta remember, for years they had this super strict ban on any local coin offerings. So this new act, it's a monumental shift. It's basically Korea saying, all right, we're ready to open our doors to a regulated digital asset market. And man, this has been a long, long time coming. I mean, just look at the timeline here. Way back in 2017, the country banned all initial coin offerings, ICOs. That move basically put the entire domestic market on ice. So now, with this act getting finalized and ready to go live around 2026, we're talking about a complete 180-degree turn. It's a total reversal.
Now, the absolute centerpiece of this new rulebook is the stablecoin. And hey, just in case you need a quick refresher, a stablecoin is a type of crypto that's designed to, well, stay stable. It holds a steady value because it's pegged to a real-world asset, like the Korean won. So you can just think of it as a digital dollar, or in this case, a digital won that can zip around the internet in an instant.
All right, this slide really gets to the heart of Korea's new game plan. They're basically opening the door to innovation, but they are installing some serious guardrails. I mean, look at this. Domestic ICOs, they're back on the table, but with super strict disclosure rules. If you want to issue a stablecoin, you have to hold 100% reserves, one for one. You got to keep customer funds totally separate from your company's money, and you can't pay interest on those holdings. The message here is crystal clear: safety first. But, and this is a big but, this intense focus on safety has sparked the main conflict we're talking about today. A really fierce debate has erupted between two of the country's most powerful financial regulators. And honestly, it's a classic fight, right? It's stability and control versus innovation and competition. And this right here lays out the two competing visions perfectly. On one side, you've got the Guardians, that's the Bank of Korea, or BOK. Their vision? Only bank-led groups can issue stablecoins, and the banks have to own at least 51%. Their number one goal is financial stability, period. They're terrified of losing control over the money supply. Then on the other side, you have the innovators, the Financial Services Commission, the FSC. They're saying, whoa, not so fast. They want to open the field up to qualified fintech firms, not just the big banks. Their goal is all about driving competition and new tech, and their biggest fear is creating a closed-off system that just kills innovation before it even starts. So to make its case, the FSC brings up this killer statistic. They point to the European Union, which, has its own big crypto rulebook. And over there, 14 out of the 15 licensed stablecoin issuers are not banks. They're what you call electronic money institutions. So the FSC is basically holding this up and asking, why should Korea be the exception? Why would we shut out the very fintech companies that are driving innovation everywhere else? It's a pretty powerful point. And it's not just the regulators. The industry is totally on board with this concern. This quote right here, from someone deep in these policy talks, just nails the anxiety everyone's feeling. The big fear is that the Bank of Korea's banks-only plan will just create this walled garden. It'll choke off the network effects and the big technological breakthroughs that stablecoins are supposed to deliver. So yeah, the stakes here are just incredibly high. Okay, but here's the thing. This isn't just some academic debate happening in a government building. Nope. While the regulators are arguing, the market is already making moves, big time. Major companies, we're talking tech and old-school finance, they aren't waiting around. They are making their chess moves right now to get ready for whatever happens next. They're placing their bets. And just look who's getting in the game. You've got the absolute titans of Korean tech jumping in headfirst. Kakao, the company behind the super app everyone in Korea uses, Kakao Talk, is building a whole stablecoin ecosystem. The idea is to link up their payment app, their bank, and their messenger for direct payments. Then you have their big rival, Naver, teaming up with the crypto exchange Upbit.
Even BC Card is already testing out QR payments with stablecoins. The race is definitely on.
But hey, don't you dare count out the traditional banks. They are not sleeping on this. They're repositioning themselves and they're doing it fast. Some of the big ones, like KB and Shinhan, are piloting stuff directly with the central bank's own digital currency project. Others, like Hana Bank, are getting savvy and partnering up with huge global crypto players like Circle, the folks behind USDC. They're basically hedging their bets and getting ready for anything.
Now, what about the global heavyweights? Tether, Circle, the big names behind USDT and USDC. Well, the new rules have a very clear message for them. If you want to play in our sandbox, you got to follow our rules. And that means setting up a physical shop, a real branch in Korea, and agreeing to be supervised locally. And if they don't, their services, things like payments and remittances, are going to be seriously restricted. It's pretty much an ultimatum. Get in line or get left out. And it looks like they're taking this very seriously. Both Circle and Tether are already on the ground, laying the foundation. They've filed trademarks for potential Korean won stablecoins, think names like KRWT and Won Tether, plus they're busy building partnerships with local Korean companies. The signal couldn't be clearer. They want a piece of this market, and they're getting ready to jump in the second the rules are set in stone. So, this all brings us right back to where we started, to that fundamental choice at the heart of this whole thing. As they put the final touches on this new law, South Korea has to make a call. What's more important, the safety and tight control you get from the old-school banking system, or the shot at explosive, game-changing innovation that a more open, fintech-friendly world could bring? Let's put it bluntly. Is South Korea going to become a competitive, open fintech hub? A real leader in Asia, right up there with Singapore and Hong Kong? Or are they going to build that walled garden we talked about, a closed system run by the big banks? A move that could push their best and brightest innovators to leave the country and lose ground in this massive regional race to define the future of finance. That right there, that is the multi-billion-dollar question. Whatever they decide, it's going to define the country's competitiveness for the next generation of finance. And you have to remember, this is the nation that basically showed the entire planet what was possible with mobile tech. So its decision on digital money, yeah, you better believe everyone from Silicon Valley to Wall Street and beyond is watching very, very closely.